TheoTrade. This is Don Kaufman, May 26, 2021. Just a few minutes to go to the cash close here on this Wednesday afternoon. The S&P is doing absolutely nothing today. The Nasdaq, much of the same. It's all about the Russell right now, which is actually up 39 handles, seemingly out of nowhere. It's actually the energy sector that's actually rocking the Russell a little bit. But hey, before we get ahead of ourselves and what is, we're coming in obviously to a holiday weekend. I think a lot of people are looking at a marketplace. It's got, low volatility, rather low volume. Listen, do not get caught off guard in this slow trade. This marketplace, okay, still has some, pent up energy, if you will. We have been in the exact same range. And I keep just reiterating this. I mean, you got 1, 2, 3, 4, 5, 6. You're in the 7th week of the identical range inside of the SPX. And there's one thing that I always point out, just again, incessantly, especially on the Wednesday evening video, that's the expected move. So if we take a look and zoom into the expected move, and I'll remind everybody here, and one of the best ways I can do that is actually to switch a gadget over here or throw it over to the scratch pad, the weekend video. The weekly expected move was right around $76.25. And you look at this and you say, okay, so what? It's $76 supposed to move, so it's $76 higher or $76 lower. And that range, again, that range is derived expressly from the options chain. But all of the gamma risk, okay, is still surrounding that $76 move, meaning that that number is static, even though the volatility, if you look at the VIX today, the VIX has collapsed back down to like the 17.5 level. Again, that $76, that's what's important, not necessarily the VIX collapse back down. And the marketplace still has an incredibly high probability of tagging, if you will, the upper and or lower edge of this expected move. And it's one thing that, hey, do we know for certain it's going to tag? No. But if you look back, okay, and it's worth looking at this because what we're referencing in this context is the difference between what we term probability, okay, of expiring and probability of touching. And when we talk about the $76 move, right? So we're looking for the $76 move higher or a $76 move lower, okay? That is actually what we term a probability, again, of expiring. So it's supposed to expire. Expire when? Friday, inside of that $76 range. And that would be like one standard deviation, right? So the $76, higher, $76 low, one standard deviation. Nevertheless, okay, what a lot of people, they don't really question. They just look at the 76 bucks and, okay, we're going to stay inside of that range. But what they don't look at is what's the probability of touching, if you will, the upper end or lower edge of the expected move. And rather than just kind of shout probabilities at you, right? Because I just don't think that necessarily does any good. But and I can throw some stats at you. Just look back at the expected moves. Look, we tagged here. Oh, here's a week that was a big donut right there. That's a big week. It's a donut. This one actually pretty much hit the lower and the upper. This one actually hit upper edge. In fact, broke it. Upper edge. This hit the lower edge. Here's a week. There we go. There's 2 weeks. Here's one that actually just came within like a point or two. This absolutely smoked the lower edge of the expected move. Here last week, we actually smoked the lower edge of the expected move, came back in. So and this is just in the very near term. You kind of get a real quick feel, you can probably bring up, if you will. And for those of you that have this, okay, this is the SPX. It's expected move, and these are all hand drawn. You can go back over months and months. In fact, you can even pull up, for example, like 3 years of expected moves, all hand drawn, and you will immediately find, okay, hey, it's only once in a blue moon that we really don't hit, if you will, the edge, the upper and or lower edge of the expected move. So, the bottom line is we have some decent economic numbers coming out tomorrow, whether it's jobless claims and GDP and pending home sales. Oh my, there's a lot coming out. A little bit of Fed speak around the fire over there, and it's more than enough, if you will, to get this marketplace a rocking. Because right now, you can talk about the S&Ps pretty much till you're blue in the face. They haven't done anything. And again, the one thing, if people look at this, they go, oh, it's dead. We're just going in a holiday trade. Forget it. They crushed the VIX. Pack your bags. Okay. And I think it's a huge and yet critical mistake in doing that. Again, we've actually seen some decent sized trades, specifically in the options around the XLF. Most of that was actually yesterday. If you take a look today, though, the XLF, which is, again, up to some 13 cents, is 0.3%. Nevertheless, it did trade some decent size today in the options, but yesterday was size by size inside of the financials. Okay, so there is some heavy positioning going on. You look at like the VVIX, all right, it dropped down by the tune of about 6%. Again, there's nothing, if you will, on the screen right now that screams risk. Nevertheless, okay, the SPX and all of that gamma risk, it cannot be overlooked. And I stress to you again and again, in situations like this, people, again, you got to recognize most of the trade today is being done via algorithms anyway. So in effect, it doesn't take a whole lot of people sitting in front of screens. All it takes, okay, the bond market starts to move, maybe on some of the numbers that come out. Okay, bonds have done absolutely nothing lately. In fact, this is a kind of a cool look right here. We're going to look at the TLT, and I was bringing this up a few weeks ago on one of the weekend updates, and you look at the TLT. Close that up for a second. Look at the implied volatility range. Have you noticed anything interesting about this? The TLT has done absolutely, and again, I'm using the TLT to reference bonds, right? But the TLT has done absolutely unequivocally nothing. And there's the closing bell. So TLT has done nothing. Nobody seems to question how come its volatility in this is actually the volatility ranking is bid. And again, it's simply because there's some pent up aggression inside of this marketplace, and again, a lot of people think that it's going to be a rather quiet summer. I would strongly disagree. Those inflation fears are going to keep coming back like a merry-go-round horror of risk. And as long as those inflation fears keep coming around, the bond market, okay, doesn't matter whether you buy it or sell it, it is going to spark, all right, some heavy movement inside of the broader marketplace. Last look again at this SPX, because one thing I really wanted to note, the upper edge of the SPX, it is 42.32. The lower edge in the SPX, and this is specific to the expected move, okay, let's just call it what it is. Let's call it about 40.80. Look for us, okay, in the next 2 days. Again, an extraordinarily high probability of touching either the upper end or lower edge of that expected move. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.